Great. It looks like it sounds okay. Just bear with me a moment. Great, everybody. Thank you so much for joining. I know it's the summertime, so I'm sure some of you, or some of you are planning holidays, or maybe you're going on holiday soon. So I do appreciate you joining. Maybe some of you are on holiday at the moment. I doubt it, but still. Thanks so much for joining. It's an interesting week. I know it's always hard, or always feels a little bit of more of a slog during August, but there is also a lot going on. So just to start with things, I just want to talk about our disclosures. Please just take a moment just to look over that. But this webinar is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concept strategies and does not include the recommendation or endorsement of any particular security chart pattern or investment strategy by Forex.com. This webinar has been prepared without regard to the specific investment objectives, financial situation and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. It will include references to actual past trading results for discussion purposes. Past results are not necessarily indicative of future results. Futures, options on futures, foreign exchange and other leverage products, they involve substantial risk of loss, guys, and they're not suitable for all investors. Spot gold and silver contracts, they're not subject to regulation under the US Commodities Exchange Act. Contracts for difference or CFDs, they're not available to US residents for regulatory reasons. So the other thing I want to point out to you guys here as well is that I will be moving between Forex.com charts provided via eSignal and also Bloomberg charts. So I'll be using those two types of charts. Basically, the Bloomberg charts tend to have the black background, whereas the Forex.com charts tend to have the white background. And I will tell you which is which as we go through them. But good morning to you all. Thank you so much for joining, as always. Just bear with me one moment. Sorry, I've been just a little bit distracted this morning. I had a few things to do, a few early kind of media bits, radio bits actually. So I've just kind of come in. So anyway, this is Cadien, which we're not going to look at. Not right yet, anyway, unless everyone's desperate to see it. But let's get going. Obviously, we've had some data out of the UK just now. This really tells a story, doesn't it? Here, all of this move higher is an interesting. It tells an interesting story, and it's an interesting one to go from kind of the shorter term chart to the slightly longer term. And I'll go through this kind of process with you now. But this is the hourly chart on cable. So this is sterling versus US dollar. And as you can see, it has some nice moves higher after dipping to a low of 155, 151. On Friday, it moved up the 200 pips. And the main reason why that has done that is because of very strong service data yesterday. And then we continued that today with better than expected production data. So some very important data out of the UK, because it really shows that, actually all of the economy is starting to do very well. It's actually starting to have a nice move higher. That's been quite significant. However, we're getting stuck yet again around this key level. That looks like a bit of a reversal there. That is a reversal pattern here. Short-term reversal pattern. Again, it is just below this 153.80 level, and it's happened yet again. And this is also the same for a chart with, for an hourly chart as well. But any candlestick chart of any time duration really, but particularly the hourlies, and particularly the dailies, if you see these long spikes higher here, it's just there's certainly noted selling interest at this level. Now, why is this level significant? Just bear with me a moment, and I will show you. Because of this area here, look at it. I'm going to circle it for you. But basically, this is a massive congestion zone here. It's, where it's cloud, daily Ichimoku cloud resistance. I know some of you, who follow me regularly will know that I do tend to like to look at the clouds. So they're not always significant, right? You go through big periods when you're not in them, go through big periods when you're not above or below either, and you're kind of in the middle of them, but they do act as very good support and resistance, and that's what I like them for. And so here, when you get to kind of a resistance level, as you can see, interesting enough, that when the clouds narrow, it's just there's no real trend. However, that doesn't mean that these resistance levels aren't significant. They still are. It's still worth looking at them. Also because it comes just ahead of a very key psychological level, of course, a whole number, which is 154. So for us, this has been quite interesting because we've backed ahead away from this 154 level. The last two kind of strong pieces of economic data coming out of the UK has caused kind of a jump higher in the pound, but it's been thwarted yet again. So what it does suggest is that people are taking profit at 153.80, and but yet they're picking it up, kind of sub 153.50. So there's a bit of uncertainty around there, but real lack of willingness to kind of push the pound any lower. Now that's perfectly reasonable. That's perfectly logical from a fundamental perspective because we've seen some better economic data out of the UK. In fact, much better in economic data. Pan, I'm going to look at Euro GBP after this. But tomorrow we have an inflation report from the UK. From the Bank of England, we get the first one by Governor Carney. First time we've heard him speak as governor, so that's going to be really important. And obviously, it's all about forward guidance. Really, they're going to make a statement of forward guidance. That doesn't necessarily mean they're going to adopt it, but it's more than likely they're going to adopt some form of it. And they've really kind of prepped the markets for that. But what would be interesting is that everyone thought Carney was going to be this uber dove, and yet he comes to the helm of the Bank of England. And within 1 month, all of a sudden, the economic data is fantastic. We're doing really, really well. Debt to GDP is okay, Michael. And on the UK side of things, it's better than the US. Obviously our austerity drive is taking a bit longer to kick in than one expected. Our public sector debt, public finances aren't fantastic. But remember, they are a bit of a lagging indicator. Largely because, our deficit, that's probably the better thing to look at right now. I think a lot of countries have high debt to GDP ratios, including places like Germany. That's the key thing. I'd always look at the deficit, look at the monthly public finance figures, and basically this economic data that's coming in that's better than expected, combined with quite a steady, unemployment rate, suggests that we could actually end up, with a, we could actually end up seeing bigger tax receipts, etc. Tapering, no, not yet. Bear with me on that one. But anyway, I want to talk about pound for now. So please bear with me, and I'll answer questions afterwards. But basically, there's expectation that he's going to be quite dovish, that forward guidance is going to be negative for the economy, negative for the currency, but that may not be the case. He's joined, as I said, Carney's joined the central bank at a time when the UK economic data is turning. And that does have an impact on the pound. Remember, the currencies are driven by fundamental events. So essentially, if we see, if we do see the pound, if we do see Carney and Co at the Bank of England give maybe less conservative, or more conservative than expected forward guidance tomorrow, maybe forward guidance won't be as aggressive as some expect, then that could be what propels us above this level. But there's certainly nervousness in the markets here. Okay, Pan, I know you wanted to look at Euro Sterling. Indeed, let's do that right now. Euro Sterling cloud analysis on a daily chart is not fantastic. Let's take a quick look at the weekly. Again, it's not the Ichi analysis, the Ichimoku analysis isn't that pertinent. For Euro GBP, what's more pertinent though is this. If you look here, double top, 87.70, nice reversal lower, and we've really had some sharp moves down. So the market yesterday ignored the fact that the Eurozone is turning a corner. Indeed, you probably would, because, it's turning corner, even though, it's still got a long way to go. Whereas the UK economy is doing really well. Service sector PMI at 6.2, that's the highest level since 2006. Goodness me, the UK economy is really, a load of investment banks upgraded their outlook for growth yesterday for the UK, and that's why the pound is outperforming the euro. It's not because the Eurozone economy is doing badly, it's just not appreciating at as fast a rate. So that's what we're seeing here. So as you can see, we are finding a little bit of support ahead of 86, around about 86.20. Now that is to be expected, because we have we have this kind of congestion zone around here. And the one thing I do want you to notice though is that we've had some very big candles, kind of on the way up and also on the way down over the last week. But preceding that, very, very short, small candles, very, very narrow ranges. And I would not be surprised if we would see a narrow range today as well. So the downside being protected. Now, why I'm showing you this chart and why I'm looking at the moving averages pan rather than the Ichimoku for me, because for me I think it's more significant right now, is because if we were to see a slightly more conservative Mark Carney, maybe some slightly underwhelming forward guidance, maybe nothing that we don't know already, then we could potentially see some further weakness in euro sterling, maybe sub 86. We get back to 85.80. That would be our first level of support. That is the 50-day moving average, the pink line on this chart. As you can see, it's followed price action really, really nicely. It would kind of mirror with these lows here as well, just from the 22nd of July. If the market is really shocked, and I think that there is a chance potentially that they will be, and then we could see just a continual grind lower in euro sterling all the way back to that 85.35 level, which is the 100-day moving average. Now I do think that obviously kind of, it's a little bit of it's going to be a bit more reactionary, I think, because obviously we don't know which way central bankers will go, which way Bank of England will go. My concern, as I said, is that, I think it's going to be, Michael, you've just said that Carney's inheriting a boom. Yeah, maybe he is. Maybe he's just come at, he's perfect timing, huh? But I think that it's, a boom is probably a little, maybe you're right. 60 and 7 to PMI sounds like boomish to me. But I wouldn't say a boom. The GDP at 0.6%, good, but not a boom. Carney is certainly inherited a UK economy in better shape. But as you rightly pointed out, Michael, there are some issues going forward, like there's still fiscal austerity that's going to be going on even longer than expected. We've still got a debt problem here in the UK. We need to really work that down. Public sector debt, for example, we certainly don't want that to continue growing because just because the economy has started to do better. We really want them to tackle that head on. What we think as well is that in our view, Carney's come at a good time. It's come probably at a more trickier time for him. It's going to be interesting to see how you can balance forward guidance with stronger than expected growth. Now, a lot of people do, obviously, you can actually say that when growth is picking up is the best time to do forward guidance, because you kind of say, no, do you know what, this recovery is good, we're going to nurture this recovery by keeping interest rates very low. I totally see that point of view, I absolutely do, but when you've got rising inflation in the UK, they do need to worry about that. We already have a target, which is inflation, and they haven't really stuck to that. So adding something like an unemployment rate to me is just a bit tricky in the UK, because obviously the unemployment rate's been quite well behaved of the last kind of year or so. I think it would be slightly harder really for them to I think it's slightly harder for them to do kind of more than that. I also think that, looking ahead, for us, looking ahead in terms of where euro sterling will go, where your cable will go, I think it's quite hard to see longer than kind of a week or two ahead in front, because obviously we may have tapering from the US in September, as you mentioned, Michael. We may also have, what the ECB have been known to be, slightly hawkish at times, or not as dovish as people expect, and that can cause problems. But tomorrow, as I said, central banks are really driving the markets higher. So that's why we think that the onus could be on the risk is that Carney and Co are more slightly more conservative than some expect, and that sounds positive. I've put a piece on our website about that, which I will show you guys in a little bit. The other thing I want to show you is dollar yen, and the reason why is because something interesting is going on. Just let me build the chart quickly. Okay, here you go. This is dollar yen, trending lower. That's the white line on this chart. And then this is the spread between 10-year US and 10-year Japanese interest rate, government bond yield, sorry. As you can see, that's moving higher. This is moving lower. Bit of a discrepancy there. And interestingly enough, apart from kind of this period here when we got Arbonomics between April and May, we pretty much moved lockstep. So this suggests to me something's got to give, right? Either the dollar's got to move higher to react or to move back towards its yield spread, or the yield spread will come down. Now, it could go either way. We've obviously got a Bank of Japan meeting later this week. We don't have too much in terms of economic data out of the US, but the one thing I do want to show you is this, which may, some people may look at this and think that actually could potentially be dollar yen that moves higher. Now this is daily, it's making cloud yet again, of dollar yen, and as you can see, we're finding nice support here, just about really at 98.30. We're currently testing just below there, but between kind of 98.05, 98.30, we think there could be some buying interest, and we're going to be watching this very closely. That chart, let me just make this one a bit smaller. As you can see here, this chart is this divergence here is a bit of a warning sign. Obviously, kind of, you know, some of you will rightly say, oh, but it hasn't held for that long, but historically it does hold. And we think that April and May were unusual circumstances, though historically this does tend to hold. And so in this environment, we do tend to think that that we could see, you know, dollar yen continuing, you know, potentially dollar yen to follow the bond yield spread higher, and for this level to hold. We don't at the moment foresee anything, not in the next 24 hours, which would potentially be a reason for us why dollar yen would continue to fall sharply. As we mentioned, overnight on Thursday, there is the Bank of Japan meeting. Now, some people are saying that actually the Bank of Japan need to get their act together a little bit, because come the autumn, they've only got 18 months left to achieve their inflation target of 2%. And yes, inflation is moving in the right direction, but it's still very low. Still kind of, you know, 0.3, 0.4%, and they want a 2% inflation rate. You know, they've got a long way to go. So they may have to say, you know, either up their monetary base target or up their QE program or something dovish, essentially to kind of boost inflation by weakening the yen, because the yen has really, you know, it's fallen quite nicely here. Now, one thing I will show you though is this. We're managing to hold good support there. I don't really need that one. Let me just take that off. Trend support is very much in place, but we are kind of, you know, we're flirting with the edges of it, that's for sure. Those, you know, as long as we can hold above there, that's good news. But likewise, you know, there isn't too much of a direction here. We're kind of stuck within a bit of a triangle. If we kind of break out of 130, which has been the highs, or 108.40 even, which were the highs from last month, then, you know, opens the way for maybe another retest to 105. But if we don't, and we get sub kind of this 98 level, then, you know, we could potentially go, why not go back to the lows of June? Right now, I think there's probably a good chance that actually what we do is we stay within this range, unless the Bank of Japan throw something out there like they're very dovish. If they don't do that, then I think what we could see potentially is the market just, you know, really kind of leaving dollar yen just on the back burner in the next couple of weeks. Remember, we have, you know, the Fed minutes, which come out. Just bear with me and I'll get you there. So we have some big events coming out in the next few weeks. So we get so this week it's all mainly speakers. 21st of August we get the FOMC minutes from July 30th. Keep that in your diaries, those dollar yen traders. And then the 22nd to 24th is a weekend, but it's a Kansas City Fed Jackson Hole Economic Summit. That's when all the central bankers get together. Carney will be there. Bernanke won't be there, funny enough. But then he's leaving anyway, so that's no problem. Draghi will be there, etc., etc. They'll all gather together, and they all have these talks. And so sometimes they announce new things there, and it's kind of very much the US's show. So do watch out for that. But essentially, watch out for dollar yen, because it is just so close to the support level. I believe that possibly that will protect the downside, especially as we lead up to the Bank of Japan meeting. Again, if the Bank of Japan meeting doesn't point to any further reason, then we could fall. 97.50 would be good downside support there. But as I said, on the upside, we're probably looking at the Tenkan line here, which comes in 99. And then above there, as I said, like, you know, 99.50-ish, which corresponds with the 50. Kathleen, what do you think are sustainable inflation levels for UK sterling. Well, inflation levels, funnily enough, in the UK are quite high, especially when you realise that we have negative real wage growth. I think probably we need lower inflation here in the UK. I'm obviously going to say that because I live and work here and earn in pounds as well. But right now, what are sustainable levels for the UK GB sterling? Well, it's interesting. Sterling monetary policy is kind of ignored inflation, because it's that kind of inflation that's difficult for the central bank to control. So, in that environment, it's hard to tell. But 2% is the target, and that should probably be the target. And they've chosen that level for a reason, even if we haven't managed to make it. Guys, have you got any questions? I'm happy to take one or two. I am going to have to knock off this call a little bit early, if that's all right, because I have an appointment. But if you've got a question, I'd love to hear one. Before we go, though, I want to show you the Kiwi, because we have got some important data coming out overnight. Seen a nice recovery in Kiwi. We've kind of bounced off this low here, which is sub 77. Corresponds to this low from the end of June. Moved higher, 79.05 now is the resistance level of note. It is the 50-day moving average. Above that, we get kind of 79.5. Again, it's all going to be about employment data, and then on Thursday, Thursday the 8th, we also get some big house price data, which is going to be critical for the RBNZ. So do watch out for that. But as we said, potentially, depending, we could if we can get above 79.05, this kind of resistance level, and we do get better data than we could, better employment data than we could get back to 80. Pan has just said Aussie dollar, yes. Pan and Derek, they want Aussie, and this will be the last thing that we look at here today. And indeed, yes, so we had an RBA rate cut, but it was a bit of sell the rumour by the fact. I remember the market had kind of expected that anyway. Got above 90 now. We did hear that there was rumoured kind of option selling around about 90, so it could be a very, very sticky level. In terms of where we go next, you've got to kind of, look at kind of 90.50 and then this 90.90 level, which was the high, 90.80 to 90. Which was kind of the high there, so just that little spike there in this candlestick you can probably see. I'll just zoom in on it a little bit. Oh, goodness me, I'm sorry about that. Must have pressed something. But I really, for us, the RBA, is still looking to, they're still worried about strong Kiwi. There's potential to cut rates further if the economic outlook is even bleaker. We need to start seeing a turn in the economic data before we can be sure that we're not going to get to 85. Over the medium term, we think we could fall lower. But right now, it was a little bit of sell the rumour by the actual fact. It had all been priced in, and because they weren't, they didn't point to an imminent rate cut after this one, so more cuts, I should say. That could have been one of the reasons why we managed to just hold on and why we managed to recover a little bit. Yeah, exactly, Pan. The statement that came with the RBA, they did say scope for further weakness in the Aussie. They kept that statement very, very much the same. They do see further weakness, which was interesting as well, and does suggest that this is going to be just yet again another sell on any rallies, and that's what we've seen in the Aussie for a while. Sell, strength, weakness again. So I do think we probably need to get above that 90 level, but we do think, it's going to be a sticky zone. If we get to kind of 30 to 50, could attract a lot of selling interest. And added to that, we've gone down kind of 1, 2, 3, 4, 5, 6 sessions in a row. You need a bit of a breather, right? The lower cost of borrowing directly imply on higher inflation. I mean, you could argue that, Michael, but essentially, we had high inflation through, 2007, 2008, all the way to now, pretty much, even though it's been, above target inflation, I should say. I think that probably, actually higher inflation usually comes down to, commodities. Which you can say, which it also has a direct link to low cost of borrowing and quantitative easing, because a lot of that money flows into commodities. And for as long as commodities remain fairly high, Brent WTI, they're still well above, $4 a gallon in the US. That's pretty tough, right? It's pretty high. That generally comes down to that's one of the main reasons for higher inflation always, I think. So yes, there is a link there. It's not as direct hopefully that's been useful. But thank you so much, guys. Great as always. Fantastic questions. Please do join me next week for more. And I will have a fantastic week trading. Sorry I had to cut this a little bit short. I will be here for full time next week. Okay, everyone. Bye-bye.